All right, my friends, I just want to take a few minutes to share with you the reason you need to reinvest your dividends, or at least you need to know how market returns are calculated, because if you're excluding dividends, you're really leaving a lot to be desired for sure. And I also want to talk about specifically the S&P 500, but I also want to point out that excluding dividends, why things like equity-linked CDs, indexed annuities, indexed universal life insurance, I'm not a fan of, because I want to show you first and foremost why that is. I think you'll get a lot out of this. All right, so let's dive right into this. So I said 2018 S&P 500 return. I don't know what this is, DQYDJ, so I didn't go on there. Y charts, I'm not familiar with that. So here we go with CNBC. I said, okay, yeah, let's see what CNBC says. And they said the Dow and S&P 500 recorded their worst performance since. And I was like, let's click on that. So let's take a look at what CNBC says. And they say, click on it right there. There we go. All right. They say more than 6% in 2018. I said, okay, there you go. So that seemed higher than what I thought. They always showed this guy too, by the way. It's weird on that. See that guy right there? Let's see. That guy. They always show that guy. I don't know why. All right, so then and I scroll down to CNN, and I said, okay, the S&P is down 6.2% for 2018. I said, well, what? Huh? I said, okay, so 6% was the market returns, huh? And so I said, okay, so there we go. The S&P 500 was down 6.2%. Let's not allow that. For 2018, well, the Dow was down 5.6%, the worst numbers since the financial crisis. All right. Is that true? And it turns out not to be true. And how do we know that? Because we go to Wikipedia, and they'll show us, this is such a great chart. The S&P 500, the return was down 6.23% price to price. Change in the index, but total return is what we need. When you include dividends, was only down 4.43%. I mean, that's a pretty significant difference there, my friend. So 6.23 minus 4.43 divided by 6.23, that's a 29% differential there without using the dividends. All right, so, I mean, you can see here in 2015, the price was down 0.73, but the total return is actually up because of dividends. You see how that works? That's a big deal. And 2011 had a no return, except with the dividends it did. So what I want to show you, so you can always remember this. So the point about this, and I looked at this chart, I said, down 6.23, that doesn't make sense. Because in 2000, the market, the S&P 500 was down 9. In 2011, it was down 11, and then 2002 was down 22. So we get 9, 11, 22%. So anything, and that's not debatable. Now, without dividends, it was down more. But when you're looking at returns, if you're seeing a return, like a chart like this, all right, that says total returns, and you go to, always remember, 2000, in the year 2000, the markets were down 9%. If you're seeing a chart that shows the market down more than 9%, then you know they're not including dividends. In the back of your mind, that's what I do. I said, okay, I'm seeing a chart that says the S&P 500 is down 6.23%. What did that chart show us in 2001 and 2? So it's 9, 11, and 22. And I know that like the back of my hand because I've been talking about it for so long. So 9, 11, and 22, but even more, it's just 9% in 2000. What does that mean relative to what I'm seeing here? And again, in 2000, the market was down 10% without dividends. I hope that makes sense. So now you have a benchmark, a framework to compare what you're seeing on. Now, let's go to this. This is actually incredibly interesting. In 1970, change in index, so the market was up 0.1% in the year of my birth, but with the index, dividends was up 4%. All right, so now we're going to go down here, and we're going to say the average return, all right, of without dividends was 8.64%. The average return since 1970 with dividends was 10.53%. All right, that's a pretty significant difference there, my friends. That's more than 20%. And so if you discount dividends like these index annuities do, and all these equity-linked CDs and index universal life insurance, when they're just doing point-to-point or price-to-price, they're leaving 20 to 25% on the table. That's a big deal. You can't discount that. All right. So the highest returns with dividends was 37.58. What year was that? 1998 or something like that? Yeah, 1995. Excuse me. And the lowest returns was minus 38.49 in 2008. So Actually, that's right there. 37% 2008. Oh, right on this side. Yeah. Okay. I mean, so with dividends, the lowest return is 37% in 2008. Yeah. All right. So anyway, you got to always include dividends. Now, if you don't include the dividends because you're holding in a cash account or something like that, which some people do, and I'm not a fan of, you still did well, absolutely, but you didn't do nearly as well as if it would have reinvested. All right. So I think that's pretty important to know. So now let's see this. When I was born, if let's just say my granddad put $1 in the S&P 500, when I was just a bouncing baby boy, that sucker today would be worth $116. All right, $116. That's a big deal. That's a real rate of return, my friends. That's obviously 10.53% a year. And so if you take 10.53% a year, you go by the rule of 72. That means that money doubled every 7.2 years. And so $1 is worth 2 and 7.2, 4 and 7.2, 8 and 7.2, 16 and 7. You can see how that goes. And so that's a big deal. From 1970 till today, 48 years that my dollar invested from my gramps would have been up to $116. That's not too shabby, without question. So keep that in the back of your mind. That shows the long-term growth. Now, I want to show you something else too, because a lot of people say, yeah, but the markets are different now. And I actually don't disagree with that. Because higher inflation markets back in the 70s and early 80s is different than they are today, for sure. But watch, this is a 5-year annualized return. We got 1, 2, 3, 4, 5, 6, 7. 7 years down out of 43 different, 7 time frames out of 43 did we have a negative return for 5 years. 7. So that's 43 or 7. Divided by 43, that's 16%. So if you invest, going back to the history of my life, you had a positive return 84% of the time if you hold it for 5 years. Positive return. In fact, the negative ones, we had one, let's just do any negative. This is annualized. So let's just do, we had one that's 0.21. We had one that's 0.57, one that's 0.59. I mean, literally, so even the negative returns, the most was, and so if we take away the ones that were only more than a return that's only more than 1% or more, we only have 2, 3 times out of 40, out of what did I say, 47, no, out of 45, 3 times out of 45 did we have negative returns that were worse than 1% annualized, and never did we have anything over 2. Does that mean, look, I'm not saying what will happen. I have no idea. But something to think about, right? I mean, literally, even in the worst days of 2001 and 2, the worst return you had was negative 2.3% annually for 5 years. 2008, obviously 2008 was bad. You had negative 2.19% for 5 years. 2011, for 5 years, you had negative 0.25. That's nothing. I'm sorry, it's nothing. So look at that. The worst that you ever had was 2.3%. For 5 years, right? Well, let's see. 2.3, 3.5. It's just, that's the worst you've ever seen. Again, that's a 50-year time frame roughly. That, it's not all encompassing, but man. All right, and the average was 10.52, which happens to coincide almost the historical annual returns. So if you're able to hold for 5 years, there's a vast likelihood that you made money, and made decent money too, by the way. Now, the lowest was 22.53, but the highest was 28.56. And so you're saying, okay, would you sacrifice 2.53 on an annual basis for 5 years to average 28.56 on the best? I would, 100 times out of 100. All right, so let's go to what's this, 10-year annualized return. All right, so now we got 10 years, so we're going to have 38 instances, 5.86 in the high inflationary time from 1966. So 1966 and 1982 are notorious for being a lackluster stock market. 5.86, 8, 6. Do we have anything? Yeah, right here. 2008 was negative 1.38 and 2009 was negative 0.95. That's it. So we had 38 instances of 10 years, and only 2 times we have negative returns. And the worst was 1.38%. That's it. And the best was what? 19.21. So again, you're playing the odds here. You're saying, should I gamble And risk 1.38% on the low side to potentially get 19.21 on the upside. I mean, that's just, it seems to me that's inherently a risk worth taking. And then if we go 15 years, it's not even, there's literally no negative years. 4.24 is a down, and 18.93 is the up. I find that incredibly illuminating. I mean, that's for 15, then you can see. And this is where they term stocks in the long term, that the longer you wait before getting out of the market, the more likely the bottoms will rise and the tops will also, they'll consolidate more towards the middle. But here, a 25-year return, the lowest ever was 9.07, which is right now. Right now. It's actually pretty interesting. So if you look at these returns here, let's go to 10 years. I think the 10 years are pretty interesting because 10 years gives us some kind of a reference point. So we started the latter part of with less than 10% returns, 5.88, 6.5, 6.7. This is when Business Week, by the way, had their claim that the markets are dead, the death of equities, right here. So we have 5.8, 8.5, 6. And then we had incredible returns, 10 years running. Look, just incredible. Now we're back into more of a mainstream, I guess, 9.3, 9.0, 8.4, 5.9, couple negatives, 1.4, 2.9. So that big error was painful for sure, but you still made money. 7.7776, 8, and then the last 10 years, 13.1. So, I think this is probably more reasonable, 7 to 8% for sure. Even going to 15 years, you can see 15 years, the best days of significant double-digit returns are beyond us. Now we're back 6.5, 8, 6, 5, 4, 4, 4, 5, 6, 9, 7. I mean, I think this is more what we're going to be looking at, just lower return environments. And so you see it wasn't very high to begin the life of me, and then it shot up because old Josh was there, and then it dropped down. But either way, it's still positive. So I think it's important to understand how this works for sure. Always reinvest dividends unless there's some reason you're not. And there's some reason you're not is you're trying to build a cash so you can buy. I get that. I just don't think you should do that. But always reinvest dividends for sure. Don't buy anything where they cut you off from getting your dividends. If you're taking the risk, you might as well get the dividends. Absolutely. Understand what the S&P 500 is as well. S&P 500 is a momentum play, by the way. I just got to say, it's momentum. And the equal weighted are not momentum. Equal weighted index, like from research affiliates and whatnot, they say, hey, we're going to give the same exposure to every single constituent in the S&P 500. The S&P 500 isn't like that. It's based on capitalization of the stock. So it's momentum. And by the way, let's just see. I'll show you selection criteria. When considering the eligibility of a new addition, the committee assesses the company's merit using 8 primary criteria. So the S&P 500 is an actively managed index, by the way. It's not as actively managed as trading all the time, but it's something to consider anyway. So active management is not dead. Why? Because the S&P 500. All right. Hope this helps. As always, we'll see you next time. Thanks now.